How does walking away from a massive, highly publicized $20 billion Apple Card partnership actually make a bank more valuable? Well, for years, the market believed that for Goldman Sachs to truly compete with the mega banks, they had to conquer Main Street. They needed retail deposits, they needed credit cards, and they needed consumer loans. But the reality? That consumer experiment became an absolute operational drag. What the market missed was that dumping retail wasn't a retreat, it was the ultimate addition by subtraction. It was the catalyst for doubling down on their true elite institutional dominance. So today, we're breaking down exactly how shedding this consumer deadweight has unleashed Goldman Sachs' core economic engine. Let's look at the numbers.
This number right here, $7 billion, represents the massive cumulative consumer lending losses Goldman absorbed since 2020. This was the cost of their retail experiment. For a firm globally renowned for flawless institutional execution, this consumer division became a heavy, volatile anchor. By signing a definitive agreement in January of 2026 to transition that entire $20 billion Apple Card portfolio over to JP Chase, Goldman essentially stopped the bleeding.
But here is what the market is missing. By eliminating the primary source of their credit provision and operating expense volatility, Goldman's underlying elite engine was suddenly allowed to run at full speed. In the second quarter of 2026, the firm posted a staggering 23.5% annualized return on equity. That's a 10.7 percentage point increase year over year. So how exactly are they generating these phenomenal returns without a massive retail deposit base?
To understand this valuation disconnect, we have to zoom out and look at what Goldman Sachs actually does when they aren't trying to issue credit cards to everyday consumers. At its core, Goldman is the apex intermediary of global capital markets. Think of them as the ultimate bridge between massive corporate entities that need capital and institutional investors seeking to deploy it. And they operate this bridge on a truly global scale, though it's highly concentrated in the world's most mature, sophisticated capital markets. If you look at their Q2 2026 geographic footprint, the Americas account for 60% of their business, followed by EMEA at 22% and Asia at 18%. This global footprint fueled a massive $20.34 billion revenue engine in just a single quarter.
Okay, let's dive into this and look at the engine itself. Strategically, the firm has completely refocused its structure onto capital-light, high-return business lines. The entire business model is now driven by institutional capital market velocity, scaling up alternative asset management and pure capital efficiency.
And honestly, this brilliantly illustrates the tale of two businesses. In Q2 2026, Global Banking and Markets generated an incredible $15.52 billion. Asset and Wealth Management brought in $4.60 billion. And then there's Platform Solutions, the legacy consumer segment that's being wound down, generating a mere $221 million and posting a pre-tax loss. The contrast is literally night and day. Global Banking and Markets is where the real magic happens. We're talking corporate advisory for M&A, debt and equity underwriting, institutional trading across equities and fixed income, and massive prime brokerage financing.
And notice this competitive moat. In investment banking, prestige isn't just a buzzword, it's a tangible asset. Goldman's brand equity attracts elite human capital, which in turn secures board-level advisory mandates. Because of this powerful network effect, where liquidity naturally attracts more liquidity, Goldman has gained 390 basis points of wallet share among its top 150 institutional clients since 2019 alone. They dominate because of what they call the one Goldman Sachs model. Look, if you're a massive multinational corporation, you don't just want a pure-play advisory boutique that gives advice but has no capital to back it up, like a Lazard or Evercore. But you also don't always want a standard universal bank that lacks the elite execution prestige. Goldman gives you the bespoke advisory of a boutique combined with the massive balance sheet financing and global distribution of a mega bank. It's exactly why they've been the undisputed #1 global M&A advisor for 23 consecutive years, capturing a 32% global market share in 2025.
Now, it's not all perfectly smooth sailing, right? We have to address the central conflict here, what the bears actually fear about this capital-light elite strategy.
So, the crucial point is this structural difference. Unlike a JP Chase or a Bank of America, Goldman Sachs doesn't have a 5,000-branch retail network. They completely lack that massive, sticky, low-cost consumer deposit base. That means to fund their immense balance sheet, Goldman relies heavily on higher-cost wholesale funding and institutional deposits. During periods of tight monetary policy or an inverted yield curve, their funding costs can spike, compressing their net interest margins much faster than their universal bank peers. That is the vulnerability hiding under the surface.
Which brings us to the actual numbers.
Does their structural advantage outweigh that funding vulnerability? Well, on July 14, 2026, Goldman Sachs reported their second quarter earnings, providing the ultimate proof point that shedding the apple cart drag and focusing strictly on their elite core is working spectacularly.
The sheer magnitude of this beat absolutely shocked the street. Net revenues hit a record $20.34 billion, completely obliterating consensus estimates of $16.12 billion. Earnings per share came in at $20.98, which is a massive 45.9% surprise over the estimates. Net earnings sat at $6.63 billion. Equities intermediation and financing hit a record $7.42 billion. The market's reaction was immediate. The stock surged 7.66% in a single session to a new 52-week high of $1,136.32.
And it wasn't just a backward-looking victory either. Management confirmed that their investment banking backlog grew sequentially to its highest level in 5 years, driven heavily by the massive multi-year AI infrastructure build-out, which requires immense capital structuring. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
Let's transition into evaluating the underlying business quality based on this data. When we look past the headline numbers, how healthy is the foundation of the firm today?
Looking at the qualitative scorecard derived from our research, Goldman achieves a strong blended score of 8.3 out of 10. Their market position is a pristine 9 out of 10, retaining that 23-year streak as the top M&A advisor. Profitability is also a 9, driven by that sector-leading 25.5% return on tangible common equity. Capital allocation is top tier at 9, as they returned a staggering 96% of recent earnings back to shareholders through billions in buybacks and a 25% year-over-year dividend increase. The only slight drag here is revenue quality, at a 7, simply because investment banking and trading inherently carry more cyclicality than standard consumer banking.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Now, before we jump into the numbers here, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. But let's map out what Goldman could look like by the year 2031.
We start from our year 0 baseline, which relies on fiscal year 2025 actuals, with the stock currently sitting around $1,119. In our base case, which we weighted a 55% probability, we assume a healthy global capital markets environment, where M&A stays steady. This points to a 2031 share price of $1,304. In the bull case, weighted at 25%, we model a structural investment banking boom, giving us a massive target of $2,029. And in our bear case, weighted at 20%, a prolonged macroeconomic downturn slashes trading volumes and deal-making, dropping the target to $440. When you apply these probability weightings, it establishes a blended 5-year price target of $1,312.60, representing an annualized expected return of 4.78% when including their dividend.
But let's look under the hood, because the assumptions are what really matter here. The base case assumes a reasonable 6% revenue compound annual growth rate, a 28% net margin, and an exit multiple of 16 times earnings. But to hit that 2029 bull case, Goldman needs a 9% revenue CAGR and expanding net margins up to 32%. And this brilliantly illustrates the fundamental dependency of this stock. To hit that high case, we need the multi-year AI capital investment cycle to translate into sustained, high-value corporate M&A and massive capital raising for years to come. If you want to access the full model with all the detailed line item assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai.
Now, we must pivot to the downside. What are the concrete structural risks that could actually break this investment thesis? Well, the risks are heavily tied to their institutional focus. First, an M&A velocity freeze. If a sudden macro shock or aggressive antitrust enforcement halts corporate consolidations, Goldman permanently loses its highest margin advisory fee engine.
The early warning sign investors should watch for here is a sequential drop in monthly announced global deal counts. Second is a wholesale funding cost shock. As we discussed, without those 5,000 retail branches, any sharp rise in wholesale paper rates squeezes their net interest margin. But the third risk is strictly regulatory, balance sheet constriction. Goldman operates with a supplementary leverage ratio, or SLR, of just 4.3%. That is the lowest among its systematically important peer banks. This regulatory cap physically restricts their ability to rapidly grow their trading assets and prime brokerage balances, compared to a peer like JP Morgan. If client demand outpaces that regulatory cap, they literally have to turn business away. It's a structural speed limit on their growth.
Which brings us to the ultimate question. Currently trading at a 19.1 times trailing earnings multiple, is Goldman Sachs justified in commanding a premium valuation in a notoriously cyclical industry? The answer lies in their transformation. Dumping the $20 billion Apple Card portfolio and abandoning the retail dream wasn't a failure at all. It was a realization of their true identity. They traded a low-margin, high-risk consumer drag for a capital-light, dominant institutional engine that is currently firing at absolute record levels.
So, to recap the three crucial takeaways for investors today. First, the strategic wind-down of the consumer credit line has successfully eliminated massive operational drag and volatile loan loss reserves. Second, their core institutional engine is undeniably dominant, evidenced by record Q2 2026 earnings, leading M&A market share, and a massive 23.5% return on equity. Third, the key things to watch next are their supplementary leverage ratio and wholesale funding costs, because these represent the structural speed limits on Goldman's growth. Goldman Sachs isn't trying to be a bank for everyone anymore. They are focusing purely on being the bank for the financial elite, and so far the market is aggressively rewarding that focus. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.sentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.